What is going on, investors? Hopefully, guys are doing well out there. We've got a 3-day weekend, so I wanted to catch up on some of the bank stocks that we did not cover that reported earnings on Friday. One of those is actually a Citigroup. Now, over the last year, stocks down like a lot of bank stocks, down about 26%, but over the last 6 months, these things have been in rally mode. This thing's been up about 9.7%. This is after reporting their Q4 earnings. We'll get into them. We'll take a look at the revenues, the profits, all of those types of things. We'll talk a little bit about when we're looking at the bank stocks, what we want to see is the Federal Reserve's impact. Okay, there's a lot of talk about the interest rates themselves and the movement that the Federal Reserve is doing. But now when we look at these bank stocks, we actually see the impact of it. I think that's actually more important than what the Fed has done or what they might do. It's what the impact already is. And I think we see clear impact when we looked at JP Morgan, when we looked at Bank of America, and you're going to see it again when we get here to a Citigroup. And I think you can form kind of a macro thesis of that in a sense when you look at these stocks. So you get a like twofold. You get a view into Citigroup, but maybe you get to formulate or get to reinforce a macro thesis that you're kind of coming up with as an investor. Now, the other thing we'll look at quite a bit is valuation over at Citigroup. It's often talked about with this company as they trade at just a fraction of their tangible book value. We'll talk about that, and then we'll come over here and look at the stock chart. The stock chart looks pretty darn good too as well, so we've got to talk about that. Now, Citigroup came in with their Q4 earnings, coming in right about $18 billion worth of revenue. That did beat expectations by a little bit. They missed on that non-GAAP EPS side. We'll talk about that here in a second, but the revenue was up about 6% year over year. The expectations for the upcoming quarter, really not expecting a lot of growth over at Citigroup. So that could be one of the reasons why a lot of people will argue that, this is worth, from a price to tangible book, it's worth considerably less than a JP Morgan, Bank of America, versus virtually almost every bank that I've ever looked at. Citigroup is consistently towards the bottom. And one reason why is, look, you're not getting a lot of revenue growth over here. We saw double-digit revenue growth projected for both Bank of America and JPM. You're not seeing that over at Citigroup. Some of it has to do with their, they're reworking their business and those types of things. From the earnings side as well, you're going to go negative for the next 3 quarters and then somehow magically produce some positive earnings growth and then go back negative. Again, not a lot of analysts covering that, but these aren't impressive. Okay, like give me a big multiple on my stock when you have flat revenue and negative EPS growth for the foreseeable future. Not going to get a lot of investors very excited. Now, I came over here to Seeking Alpha, and I like to peruse the articles occasionally. This one was actually pretty good by IP Banking Research. I'll have a link to that in the description below because he brought up some interesting points that I want to talk about on today's video. He said that Citi reached a milestone of 13% CET1. Now, we're not talking about what football players have going on in their brains. We're talking about Common Equity Tier 1 capital. And without, getting into the Basel 1, 2, and 3 regulations that are layered onto these banks, essentially what in an event of a crisis, equity is taken first from Tier 1 capital over at banks. Many of the stress tests that you see implemented by the ECB and here from the Federal Reserve use Tier 1 capital as kind of the starting measure to test the bank's liquidity, so kind of their financial health. And what this author brought up on Seeking Alpha was the fact that the CEO targeted a 13% CET1, kind of a Tier 1 capital ratio of 13%. And once they reached that, they were going to be able to buy back more shares of Citigroup, which again relates to the fact that the stock is so undervalued compared to its tangible book value, its book value, and certainly compared to its peers. Buying back the stock probably makes a lot of sense. And they reached this Tier 1 capital ratio a couple of quarters. I think they were looking at Q3 of this year, and they've already reached it. And also inside this article, they pointed to, I think, a candidate for earnings conference call question of the year already came from Mike Mayo, who I believe works for Wells Fargo. He says your capital Tier 1 ratio is 13% now. And I think that's 2 quarters earlier than consensus had expected. You said it was up 70 basis points. So doesn't that allow you to repurchase stock now? Or I understand it that you go ahead and sell your Mexican business or your business in Mexico, that could have temporarily have a negative hit. So what's happening over at Citigroup is they're starting to divest out of some of their consumer banking businesses. They're doing it in China. They're doing it in Mexico. That's what Mike Mayo was referencing, is as they divest out of these consumer banking businesses, they're trying to sell them, they're trying to wind them down, or maybe a combination of both. As they do that, they take accounting hits. And as they take those accounting hits, it actually impacts their tier one ratio. So it looks like 13%, but as they start to sell off these assets, well, it might change that ratio, at least in the shorter term, again, really from accounting perspective. So he goes on to say, so I'm just thinking, like, don't sell your Mexico business, don't have that temporary capital hit, start buying back the stock at a fraction of your tangible book value. So what's wrong with my logic, or what part can you comment on? I love analysts that basically say, you should be doing this, and why aren't you? This is one of the reasons why I don't publish on Seeking Alpha a lot, is because they constantly try to get me to edit my articles, because I'm very much in the same vein as Mike Mayo. I like to tell companies what they should be doing. You should be doing this. They should be doing this. And the editors over at Seeking Alpha don't always agree with my commentary and want me to edit those types of things. Now, the CEO went on in a very CEO type of response, saying, we laid this out in our investor day. We have a strategic plan to divest out of these businesses, and from an accounting perspective and a tier one capital, and then from a regulatory perspective, we want to basically play it safe. But all things being considered, once Citigroup kind of gets past these divestitures and those types of things, well, you probably got buybacks and all those types of things coming down the pike. Now, CEO also commented that October and November were good months in terms of trading activity. In fact, they saw very, very positive trading revenue seen in the most recent quarter, up 10%. But like a lot of things in finance, those were offset a little bit by investment banking revenues expected to drop about 60%, as those rising interest rates and growing recession concerns hinder M&A activities and capital market businesses. We certainly see that when we get over to the numbers. Now, the other thing with Citigroup is you don't have a growing dividend. Now, it was growing for a little while, but really for the last almost 3 years, you've been stuck at about 51 cents per share. And when we come over here to the financials, this is a company that could certainly grow that dividend, certainly could grow its buybacks, but it's obviously playing a very, very slow game. When we come over here and look at what this is our credit card metrics. So these are our default rates, our delinquencies rates. We looked at this when we looked at JPM and Wells Fargo and Bank of America. You've got your delinquency rate back in 2019 here on the far right-hand column. That was at, we'll call that 1.6%. Delinquency rates still under 1% for Citigroup. And your charge-off rates are at 1.3%. They were nearly double that back in 2019. So yes, they are trending up. Both delinquency and the charge-off rates are trending up, but they are still not anywhere close to where you're in 2019. The bank stocks still relatively healthy. Now, when we come over here to the financials, we got that $18 billion worth of revenue. We talked about how that was 5.8% growth. They call it 6% on their own financials. Here's where you see evidence of those net credit losses. So you're seeing an increase of delinquencies, increase on credit losses or charge-offs, if you will. You see year over year, those are up 36% from $866 million up to, we'll call that about $1.2 billion. Even quarter over quarter, you went from about $900 million again up to about $1.2 billion. That was 33% growth. So obviously you don't want that trend to continue that rapidly. You want that to start flattening out. They can very comfortably handle 1.2, maybe even as high as $2 billion worth of credit losses, but you wouldn't want this 30% growth rate on that type of thing to continue for a prolonged period of time, because obviously that would, require even more capital being set aside. And here's where that is: total provisions for credit losses and benefits of claims. You see, last year, they actually released about $465 million back into the company. That really bolstered up your operating income and your net income. Now they are seeing, obviously, increasing credit card losses, delinquencies, charge-offs. So they're having to set aside more and more money. Now, the company looks like they've gotten out in front of that. Over the last several quarters, they went from $1.3 billion up to about $1.4, and now we're up to about $1.9 billion. Every quarter, they're allocating more and more money to charge-offs and delinquencies. You see, quarter over quarter, it's up 35%. And year over year, it's just astronomical because you went from a negative number to now a very positive number. That is impacting your finances at Citigroup, as you can imagine, because we grew our net revenues by 6% over this company. Our operating expenses actually went down 4%. So the company actually, in a vacuum, is doing a very nice job. I actually think management at Citigroup, while they're being very prudent, very conservative, in some ways they have to from a regulatory perspective, I actually think they're doing a very good job. And if we could have a quote unquote soft landing, or even kind of a medium landing, or whatever's in between soft and hard landing, I think this company is very well positioned because they're doing a very nice job. They're getting out of businesses they view as kind of unprofitable or just kind of a drain on the company's finances. That is helping lower operating expenses. And if you could kind of put a halt to these credit losses, well, all of a sudden this bank's probably in pretty darn a good position. But broadly, like I was talking about, our revenues increased 6% year over year. Our operating expenses decreased 4%. So typically, from a net income and an income from operation perspective, you usually see a pretty large increase here, but actually we saw a very large decrease. So 20% drop year over year. Last year, you made $3.2 billion. This year, just 2.5. That's even a 28% decline from the previous quarter, where you earned 3.5 billion. And almost all of that, again, has to do with the fact you're setting aside more and more money for these credit losses that are perceived to potentially come. Now, again, if you have a quote soft landing or a medium landing, or people, all of a sudden start paying their bills and not declining to pay their credit card bills, well, all of a sudden, you can start to release some of this money back like they did in the fourth quarter, that'll bolster up your operating profits, your net income, those types of things. Obviously, those are hard to predict, and we'll see what happens. Now, with all of these bank stocks, it's reinforcing kind of a macro thesis that I have, that the Federal Reserve is constantly raising interest rates, and it's having a real impact on the economy. And I know that they are saying that they need to go higher for longer, or they need to continue to raise rates. I constantly get comments, well, what about a quarter basis point or the half basis point hike that they'll do in February? Well, look, it's already priced into the market to a certain degree, and it's already having an impact. Here's your average deposits over at Citigroup. Those are down 3% year over year, 3% quarter over quarter. Here's your mortgage originations. Take a look at this. This business is just falling off a cliff, down 36% quarter over quarter, down 21% year over year. That is already a dramatic, we're talking about a dramatic decline. And then when we come over and look at Wells Fargo, we'll probably look at SoFi, we'll look at Upstart, we'll look at other fintechs out there that have even a larger mortgage business. You can certainly bring up Rocket Mortgage as well. And these companies have been decimated. And it's not like that's coming back. It's not like that if the Federal Reserve just pauses interest rates, all of a sudden everybody's going to go take out a home loan. No, it's not coming back until interest rates significantly go back down. You come over here and you look at your global wealth management business, and you're seeing a similar type of thing. Client assets year over year down 8%. Average deposits down 1%. U.S. mortgage originations down 43% quarter over quarter, down 29% year over year. This is contraction. This is slowing the velocity of money. This is everything that the Federal Reserve wanted to do. So everybody that says, oh, they're going to have to go even harder. No, this data shows that what they are doing is working, and they are going to be able to pause and likely reverse sometime this year. They're going to pause very quickly this year, and they're likely going to have to reverse, because if this maintains itself, these negative type of growth rates, well, all of a sudden your bosses in Washington that want to get reelected in a year or two's time are going to get very, very angry with you. Here's your tangible book value over at Citigroup. Right now, you're about $81 per share. Your book value, that factors in things like goodwill and other intangible assets, that's at $94. The stock is currently sitting, we'll call that about $50. So your tangible book, if we were just liquidate Citigroup and say, you're going to go away Citigroup, and we're just going to liquidate all the assets and keep all the positive assets and positive income, and we're going to divest out of all our liabilities, we'd be left with $81 per share. So clearly you're trading at a fraction of book, currently trading at about 0.61 times. Again, that is a fraction of your book value. But I think the mistake that Citigroup investors often make is they try to compare this to JP Morgan. They try to compare this to Bank of America. I would say largely I would not do that. I would just compare this company to itself, and even to itself still looks pretty darn good. Okay, a 0.61 tangible book. Now, it's been lower. It's been lower back in 2020. It was lower just a couple of months ago back in October, but we're not talking exponentially lower. And it's certainly been higher than that. I mean, we're talking a year or two ago, we were over nearly 1 times tangible book on this company. Will Citigroup ever catch up to where Bank of America is or where JP Morgan is, which is in the stratosphere compared to this company? I don't think so, but we certainly have room to get back to maybe a more sensible tangible book, especially if this company kind of gets out of its conservative mode, increases its dividend, increases the buyback, gets out of businesses that they feel that aren't profitable and just kind of drain the company resources. And then we get on kind of the other end of this financial crisis that we're in. Well, all of a sudden, this company's probably looking pretty darn good. And now what's also looking pretty darn good is this stock chart. Now, obviously, if you bought this stock, pre-2007, you got to learn the art of selling a stock as it just is absolutely falling off a cliff. But minus the, 1 million% drop that this stock had during the financial crisis, things have actually looked pretty darn good. I'm on a weekly chart here. We've got, about 10, a little more than 10 years of data. And for the most part, we are in a very beautiful uptrend. We're creating a series of higher lows, higher highs. We're currently towards the bottom of that. So from a technical perspective, now from a micro trend, it's ugly. Okay. Ugly trend. This is why everybody's still super bearish on the market, because they're focused on this dramatic drop that we've had from $77, $78, $80 per share all the way down to 50. But in the broader sense of things, this stock has done this, 3 or 4 times over the last decade or so. Gone to the top of the channel and it's come back down to the bottom of the channel or very close. And now here we are at the bottom of the channel on this one. So if you like this one from a tangible book value perspective, if you like the management, if you like the direction, certainly if your macro thesis is we are going to have a quote unquote medium landing or a soft landing, if you will, maybe not some just gigantic depression or recession, which I don't think a lot of people are really pricing in or even factoring into the markets these days. This certainly can be a stock that you pick up because you are getting a 4% dividend yield. If we do get a Federal Reserve that starts to be a little bit more accommodative, well, a stock like this could rally pretty quickly back to the top of the range, back up here to about, we'll call it $85 per share. Folks, that would be at just a 75, just to maintain the technical pattern that we've been in for a decade or more with Citigroup. That would be a 75% move. This is why I'm telling you here on the channel, you should be really focused on accumulating stocks. You should be looking to buy them. You should be excited about these 75% drops that we've experienced because they are often followed by rather large increases in stocks. Now, obviously, if you're old, if you're in retirement, if you need this money to buy a house or for a medical bill or for your kids' education, you have to make those decisions on your own. But if we're just talking about long-term investing, buy and hold, let it grow type of things, these drops are exactly what you dream of. And those that are willing to step in will experience these 60, 70, 80, 100% type increases on stocks, and the rest of you that are waiting for Jerome Powell to tell you to buy stocks will miss out on a lot of that. Hopefully you guys enjoyed today's video. We'll be back again with more. We've got, again, a 3-day weekend as we celebrate Martin Luther King's contributions to society. We'll probably have a video on Monday as well. Till then, we'll see you again soon, and good luck with your investments.